Hey traders, Todd Gordon here of tradinganalysis.com. This is your free video update. This is going to be for Tuesday, May 5th. So it's 5/5/2015. And let's talk about bonds, bond yields, and the impact it's having, this move in bonds is having on interest rate sensitive sectors. So to set up the concept here tonight, we'll take a look at the 30-year U.S. bond. We'll look at the 10-year. No. And this is the 2-year. And what you'll notice is look at the degree that the 30-year has sold off relative to the March low compared to what the 10-year has done relative to the March low compared to what the 2-year has done relative to the March low. And you can see that the longer the bigger the maturity, the closer we are to the that March low. So what that means is there's more weakness in the longer term maturities. So this is the weakest, 10-year is the middle, and the 2-year is the strongest. And remember, this right here is a chart of price, right? So if you were to look at bond yields, which are exactly opposite, the 30-year bond yield is going to look like that. The 10-year bond yield is going to look like this. And the 2-year is going to look like this. So what that means is on a relative basis, let's go over here. Let's just kind of draw something down here. On a relative basis, let's say it's anywhere from 0 to 1 to 2 to 3%. Okay, if you were to chart the 2-year, it'd be like right around here. If you were to chart the 10-year, it'd be up here. If you chart the 30-year, it's up here. And basically the shape right there of your 30, 10, and 2-year yields is going to look like this. So this is going to be your 2-year, that's your 10-year, and that's your 30-year. What's happened is the yield, which they call the yield curve, is going more towards this. A couple months ago, it was more like this. And even before that, it was more like this. So what's happening is the yield curve is getting steeper. And that's good for one sector in particular, which is financials, because what they like to do is borrow in the short term and then lend in the long term, which means they borrow down here and then they lend out to you and me at higher interest rates. And that difference is the spread, which is their net interest margin, which is how banks and life insurance companies make money. So the steeper this yield curve gets, the more money they make. Okay, so this, what's happening in the bond markets, is a big reason that your financials are acting strong, and the XLF has actually just started to break a recent range. And if we can get above this resistance, we have room to go in the financials. And that could be the thing that saves the market. Okay, so a trade I'm looking to put on tomorrow, which actually sets up pretty nice for an earnings trade, is a major life insurance company or insurance company, which is Prudential. Okay, we're coming up on earnings tomorrow. And Prudential is set to break. We did threaten to break the top end of this range here, right at the 618 projection of the prior upswing. And it looks like with anything that looks like decent earnings or at expectation, I even think because of what's happened lately to the slope of the yield curve, I think any bad news is going to be discounted, and I think we're going to reach up to the 100% projection at 88.11. So we're going to be looking to put on an earnings trade tomorrow. So let's just take a look at this real quick here. PRU, we have an expected move of $2.76. Okay, so that's a market maker move. Okay, so let's take a look at this in the option chain, Prudential. I'm going to be looking to do this in the monthlies, just 11 days to go. We have implied volatility pumped up quite a bit here in Prudential because we do have earnings tomorrow. So that implied volatility is in the green here, is in the upper end of the range, and post earnings, just like we saw here, you're going to get the IV crush. Just like here, you get the IV crush. So a good way to play that would be to be short some put credit spreads just above the or just below the potential breakout area, which is like, You could do even like an 84, 83 put credit spread. Normally we would do this with weeklies, but it doesn't look like Prudential has weeklies. So 11 days out is fine. It's something I would take as a breakout trade anyways. So I don't even think you need to get so far below the expected move, $2.77. Let's just go like $2 below. So instead of 84, we'll see where we are tomorrow. I'll probably be looking to do like an 80. We have an 82.5, so we'll be a little bit less than one standard deviation. We could do like a 82.5, 80 put credit spread. As of the closing price for $2.5 wide spread, you get about 60 cents, which is about a quarter. So that's not terrible. We'll be looking to do a $600 versus a max loss of 19, and of course we're not going to let it go to to full max loss if we can help it post earnings. But it's a trade that I think is going to work because I think markets will discount any poor earnings as to what the future will hold in terms of what's happening on that yield curve. All right, guys, we'll leave it there, and good luck trading. Hope it helps. Talk to you in the next update.